Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing CUBIC stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. CUBIC Corporation is a transportation and defense company. It operates two business segments. The first is CUBIC Transportation Systems, and the second is CUBIC Mission and Performance Solutions. CUBIC Transportation Systems designs, integrates, and provides technology for automated fare collections for public transit. The company operates Ventra, the electronic fare payment system for the Chicago Transit Authority. CUBIC Mission and Performance Solutions provides communications, intelligence, surveillance, and reconnaissance for the U.S. and allied nations. Let's get started with the model. This is a mid-cap company, $2 billion market cap. They're trading at $62 a share, and they have 32 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So the company does have negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. They have negative net income 2 years, positive in 2 years. Revenue is a sales for the company, and that's pretty steady. $1.5 billion in 2017 and $1.5 billion in 2020. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Then the difference between those two numbers is their gross profit. They do have positive and growing gross profit each year, up to $456 million. Below that is operating expenses. Depreciation is part of operating expenses. Then below that is operating income. And they also have positive operating income every year, and that's been growing. Below that is the interest they pay on their debt. Then there's other income and expenses. So the bottom line of the income statement is their net income. They did have negative net income in 2020, mainly because of the negative $61 million in other income and expenses. They did have positive net income in 2019 and 2018. This is the company's statement of cash flows. Operating cash flow minus CapEx gives you your free cash flow, and they have negative free cash flow every year. So it looks like they're in growth mode. They're investing a lot in their company to grow it. That's why they have negative free cash flow. The company issued $215 million of capital stock in 2019. When a company issues stock, it dilutes the current shareholders. They do issue and pay down debt each year, but they haven't added too much debt in the past 4 years. Let's look at their operating cash flow. The way I think of operating cash flow, it's net income converted to cash. Net income is your accounting profit and loss. There's a lot of non-cash items in there. And the way you calculate operating cash flow, you start with net income. Then you have to add back $88 million of depreciation. You have to add $22 million of stock-based compensation. It looks like they had negative $140 million in changes in working capital. When a company sells on credit, that detracts from cash flow. Also, when a company buys inventory, that detracts cash flow. And when a company pays back accounts payable, that also detracts cash flow. The company did have positive operating cash flow in 2017 and 18, but negative in 2019 and 2020. Let's look at the capital structure. $1 billion of equity, $900 million of debt. They're 52% equity, 48% debt. And their WACC is 7%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's $4.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3.6 billion. We divide that by 32 million shares. And we get a calculated stock price of $112. They're trading at $62, so they're trading at a 44% discount. It's a buy according to the model. Simply Wall Street values the company at $145, so they're saying it's even more undervalued than me. So I was not able to use a regular discounted cash flow model for this company because they only had negative free cash flow. So I had to look at analyst estimates and also look through the 10K to get an idea of their future free cash flow. Of course, no one can really predict the future, but if their cash flows are higher than what I'm predicting, then the stock price will be even higher than what I'm projecting. But if it's lower, then the stock price may come out lower. The stock seems to go up and down. It was driven up all the way past $70, then it came back down, back up, all the way back down, and it looks like it's coming back up again. This company pays a semi-annual dividend of 14 cents, and their dividend yield is 0.43%. It's pretty surprising to see a company pay a dividend that's not generating any cash flow. So they need to sell more stock or issue more debt just to pay their dividend. Their beta is 0.89, so the stock moves a little less than the market. The stock has gone down 4% in the past 52 weeks, much worse than the S&P 500, which went up 14%. The 52-week low was 31, the high was 68, and the stock is trading above its 200-day moving average, but below its 50-day moving average. About 200,000 to 300,000 shares are traded each day for this stock. Almost all the shares outstanding are on float. It looks like most of the shares are held by institutions. This number should not be over 100%. It must be a timing issue with Yahoo's calculation. And they have a pretty high short percentage. Over 13% of the shares on float are shorted. If you invested $10,000 into this company 10 years ago, you would have been down for most of the time, but if you would have held out, you'd be at $13,000 today. Not the best return on investment, but at least it's not a loss. BlackRock is the biggest shareholder at 16%, then T. Rowe Price, Vanguard, River Road Asset Management, and State Street. Let's look at the financial ratios. The average PE in the market's 10, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price to sales is stock price over sales per share. They're at 1.4, so investors are paying $1.40 for $1 revenue. Price to book is stock price over book value per share. They're at 2.0, which is better than the median and average. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $1 billion of equity, negative $34 billion of tangible equity, because they have $800 million of goodwill and $200 million of other intangibles on their balance sheet. Interest coverage ratio is EBIT over interest expense. They could almost cover their interest payments 3 times. ROE is net income over equity. They have negative net income, so they have negative ROE. Current ratio is current assets over current liabilities. They're at 1.3. They have a good current ratio. And their current assets are $130 million of cash, $440 million of receivables, and $130 million of inventory. So it does look like the company does have enough funding to get through the next 12 months without needing to take on any more debt. They did have negative free cash flow, but they have positive $176 million of working capital, and they have a $17 million dividend payment. That gives them $100 million of funding, assuming they have a similar free cash flow in 2021. The best way to look at ratios to compare them to similar companies, I've done videos of 17 companies in the same industry as Cubic. And if Cubic has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're worse in PE because they have a big negative. Price to sales, they're much better than the average. Also price to book, they're better than the average. Current ratio, they're doing fine. They have a bad ROE. They're about average in debt. And they're a pretty small company, only $2 billion market cap. Average is $35 billion. And they pay a smaller dividend than average. So to summarize, I do have them trading at a 44% discount, but that's based on the expected future growth of the company. Of course, anything can happen. They may not grow and become bankrupt. That's a risk you need to take. I rank their free cash flows 1 out of 10 because it's always negative. I rank their revenue 5 out of 10. $1.5 billion is pretty small, but it's okay. But it looks like they're in growth mode, and that may become bigger in the near future. I rank their ratio 6 out of 10. They have a really bad PE, they have a bad ROE, but their price to sales, price to book, current ratio are pretty good. This is a really interesting company. It seems like they have a really unique business model. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.